Hello again, Darren from Invest Your Income. Talk about how much of your income should you invest. 23.5%. Only joking. We can do 23.5% if you want. It all depends how much money you've got coming in, all your expenses. People want a figure, and we'll come to that at the end. But basically, it's going to completely depend on your circumstances. I know you don't want to hear that. But the fact of the matter is, it's dependent on a couple of key factors. I'm just going to go through them quickly here, okay? So, obviously, if you've got your income and you can afford to put it all in, why wouldn't you want to put all your income aside for investments? Investments do contain risks, but at the same token, you're skewing your future. Because the way we invest, if we try and do it cleverly, that we don't get wiped out in economic crises and crashes and all the doom and gloom. We invest over the medium to long term. If we're doing short-term investments, we get extra capital to reinvest for the long term. That's how you get wealth over time. What is the goal of your investing? If you're out to get quick cash now, that isn't investing. Okay, investing, you want to be putting money aside for the long term, for retirement, or what you consider to be a retirement. If you want to sit there reading the paper all day, a lot of people don't retire because they can't stand it. So it depends when you want to retire, what sort of lifestyle you want. The ideal lifestyle, from my point of view, is to get some additional money coming in, so you don't have to worry, so you can pick and choose the kind of work you do later in your life. So short-term for profit or long-term returns over the decades. Okay, we're talking about long-term. Okay, I'm in my 40s-ish. So, realistically, I've got 20 years, haven't I? Before I'll be looking at wanting to get more money back. My goals are slightly different from that, but I'll go into my goals later if I do more videos on the subject. So, long term, you're talking about decades returns. Therefore, we don't need to worry so much about short-term fluctuations as long as we protect what we're going to invest over time with natural cycles that there are, bar any cataclysmic world events that are going to change. But if they were to happen, then none of what you do is going to work anyway. Your pension will evaporate first thing. Okay, so it's, if you talk about these doom and gloom scenarios that are out there on YouTube, if those things happen, then you can forget all your money anyway, because it won't exist anymore. So we're talking about normal scenarios where we've been looking over decades, and over time you'll get returns on your investments the way we do it. Okay, sorry about the way I've done this, by the way. Kind of what I just said. Don't panic. Crises happen. We know about the 2008. We know about the dot-com bubble. We know about all the other crashes that have happened. Okay, we can flick over to our charts here. See here, today, last couple of days, we've got a hammer here actually. Last couple of days had big sell-offs, not comparatively, but fairly substantial sell-offs in the Dow Jones Industrial Average. Are we going to panic? Okay, if we go pull out of this over time, we scroll down the bottom, we got from 2011 to 2019. You can see we're quite high. We're going to be, this has been ramped up for a long time. We've had big pullbacks coming in. Chances are the market will go down. Okay, but this is the average for the Dow Jones. Okay, it's not something we need to panic down here and start selling. Okay, and for it only to rebound and go up again. Okay, over time, over a long time, the crises and the crashes, they do happen. If we go back to 2008. Okay, a big crash. Okay, a massive crash. Lost half its value. However, 4 years later, back up to where it was, right up to where we are now. Okay, we don't need to panic. That's what long-term investing is all about. We don't panic. We invest for the future. Okay, yes, that. Back to our little chat here. And we're going to go have a look. So be objective and above all patient. Apologise. This is the hardest lesson. Now when I say this is the hardest lesson, it's taken me probably 10 full years immersed in investing and trading to realise that you don't need to panic. You be patient over the long term and you're going to win. Okay, this is how wealth is generated over the long term. Short term, sure, you can make some money, extra money, but your wealth is generated over the long term. And long term, I'm talking 30 years. That's my personal interpretation of a long time. If you're a little bit older, like me, you've got 20 years or 15 years, 10 years even. I'll go through a quick spreadsheet in a minute, so we're not all panicked. Okay. So, if you need the money that you invest, you'll pull it out too early and you could lose. Key is to keep the investment going. So many people have issues during their lives, like everyone does. Money fluctuates, or for whatever reason they go through a hard time at some stage in their life, or extra bills or whatever. They stop investing and the whole thing falls apart. As soon as you stop any savings, or you can access those savings too readily for a lot of people, they panic, they pull the money out, the thing falls apart, and they've got nothing left again. It's completely pointless. You have to stick at it, and you've got to be determined that that's what you're going to do, and you just ignore that money, that part of your income that you invest, you ignore it. So you're better off, in a way, going for a lower percentage of your income that you invest, purely because it's easier to stick to this. Some people are saying, 30, 40, 50% of their income putting away. Over the long term, for the impacts that will have on your standard of living, that's going to be extremely difficult to maintain. People do it, and if you're completely dedicated, and you can do that at some kind of level, and you've got that kind of income, great, that's what you want to be doing, because then you really will be flying, especially when you see the spreadsheet I'll show you in a minute. So a figure is difficult, and it depends on your retirement plans above all. What have you got planned for your retirement or your latter life, or do you want to retire earlier, work part-time, take the pressure off, or just use it to pay all your bills and things? How are you going to use it? Okay, you've got to get a plan together so you know what you're doing, rather than aimlessly investing and not knowing when to pull it out, because it'll get to a point where you start to see either return or you want to take the money out. You've got to have some kind of plan, so it doesn't just, just blow it, which is, I've seen so many times. So I would say, in addition to your pension, you want to be contributing 10% minimum, ideally 25%. Okay, that's of your income. So that's your disposable, that's your income after your, obviously, deductions and your pension. Okay, so it's a significant sum, but it's at 10 to 25%. It's manageable for most people, and don't panic above all. Just keep this going and ignore it, like you do your pension contributions if you do pensions or 401ks or whatever it might be. Here we go. So, quick little spreadsheet. This has probably been done many times before. I hope you get something out of it. So here I've just got an example at the top. We're looking at your contributions. So say you contribute $100 monthly. That'll be $1,200 over the year. 12,000 in 10 years. 24,000 over 20 years. And after 30 years, you've got 36,000 put away, which I think, just in itself, compared to what most people have saved, is actually a considerable amount. If you think of 36,000 for only $100 or pounds or euros, whatever, invested initially, after 30 years, you're going to have a lump sum of 36,000. I find that pretty incredible, just with the way people don't save these days, the way people don't invest their money. If you did that, ignored it, that's what you'd have. Now, the magic happens when you compound your profits. Let's go on an average of 4% return compounded. So we've got 100 invested here. So the comparison here is year 1 is 1200 to 1248. Year 2, I haven't got the years separated up here. Year 2, you're 2497. You can see 3797, 5149, 6555. Okay, we get up to year 7. We're at 9538, and year 8, 11, and the changeover comes between halfway through year 8. You've already exceeded your 10 years before. So effectively, you've got a year and a half compounded extra. So you come out with 14,475 after 10 years. And you extend that out. So you go 11, 15, 16, 18, 20, 22. And at 20 years, we're at 24,000 here. We got to year 15 with 22, year 16 with 24. We exceeded 24 in year 16. So we're at 24,815, 27,000, 29, 31. So now at 20, after 20 years, you've got 34,000 compared to 24,000. Okay, significant increase. Okay, you've got 10,000 extra in your account just by compounding the exact same initial investment. And 21 years, you've got 36, 39, 42, 45, 48. So your 30-year number is 36,000. And that happens year 21. So then we got basically 10 years of savings. 51, 54. You get up to 64, 65,000 compared to 36,000. That's investing the same amount each month, but you compound your returns. That's it. That's it. So I know which one I'd rather have. Okay. Now you might say stock markets change and la 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 la. That's true. But if you look at 30 years of the stock market, let's have a quick little look, shall we? Let's just change it back over to, excuse me a second. So look at Dow Jones over 30 years. So say we're looking at 2019, all the way back. It's 1999, 2009. We can see we might have gained some capital as well during that time, right? We might have gained some capital in that time. Yes, you've had your crashes, okay? There's 2000s, yeah, we've got 2008. When you zoom out like this and put it on a weekly chart, which is what I'm at the minute, you can see we might have made some money over time as well. So the magic happens in two forms. Your money grows at 4% on your returns, in addition to your capital growth. So if we're investing in shares, for example, that pay dividends, we get a 4% return average. If we're doing well, yes, the dividends will fluctuate slightly sometimes. Overall, if we say 4%, and then you look at your capital appreciation over that time, over 30 years, most likely you're going to be well in excess of that over that time. Okay, if we have a 30-year contraction, which has never happened in our history, but that's the only way that wouldn't work out. And even then, you're looking at your whole portfolio is going to have to be down after 30 years. Okay, it's just not going to happen. Okay, it's not the way the whole economy works. So we can see it's an uptrend, so you're going to appreciate. So that figure is not going to be that; it'll be a lot higher. Okay, because your portfolio will increase in value over that amount of time. And that's the difference with compounding to just putting your money in a savings account that gets you zero waste of time. Savings accounts, but it's better than nothing. I'd rather put it aside like that than do nothing with it. So that's it. I hope you enjoyed it. Hope it wasn't too boring. It's kind of it's one of those subjects that you have to just kind of get through. Once it actually clicks in your brain and you realise, I'm not saying it hasn't clicked, obviously it might have clicked, but that's why you're looking at this video, but whatever your circumstances are, this is the way to make money, period. Okay, however you're going to invest it and compound it. If you compound your savings and whatever you're invested in, you're going to make a lot of money over time. Hope you enjoyed it. Sorry it went on too long. Take care, and I'll talk to you all soon.